We are going to cover in this presentation work paper entries when the parent owns 100% and uses either the equity, initial value, or partial equity method for the investment in sub account. Now we're going to use this example. In this case, on January 1st of 2016, Mike Tech acquired 100% of Danny Tech for $800,000 cash. Danny Tech had common stock of $400,000 and retained earnings of $200,000. A patent was undervalued at $50,000 with a 5-year remaining life. Now here is Danny's net income and dividends over the next 3 years. We total those up to get $590,000 in net income, and dividends paid out was $140,000. On December 31st of 2018, Mike owed Danny Tech $25,000, making it an accounts payable on Mike's books and an accounts receivable on Danny's books. And we need to take that out because that's an intercompany transaction. Now, what do we need to do? Well, we need to look at the worksheet entries in terms of what happens if the parent uses the equity method, which means that they record the initial investment and adjust the investment account for their share of the sub's net income, less any dividends, and when we use the equity method, dividends are treated as a reduction in the investment account, not as income. And we also have to subtract out any amortization of undervalued assets. If we use the initial value method, we do not adjust the investment account at all. When we use the partial equity method, we will adjust for our share of the net income of the sub, less any dividends, but we will not adjust for amortization. So now we're going to walk through the entries. Okay, first, what we need to do is figure out, do we have any goodwill or do we have any amortization? So we had consideration of $800,000. We had less the net book value. Now, here's the thing to remember. In this problem, they only give us the equity, and we know that assets minus liabilities equal equity, which would also equal the net book value. So remember that when you're working the problems, you have to remember that accounting formula. Also, if they only give you the sub's retained earnings at the time of the purchase, you know that their ending retained earnings after a number of years would be their retained earnings plus any net income minus any dividends, if you need to figure that one out. Now we subtract these two and we get a difference of $200,000. We know that we have an undervalued patent of $50,000. We figure out what the amortization would be each year, and the difference would give us goodwill of $150,000. Now we're going to do entry S. We're going to remove the balance from the sub's equity account. Now the common stock, we're assuming no other stock was issued because it didn't say there was, but how do we remove that retained earnings because we know 3 years have gone by? Well, what we need to do is take the retained earnings when we bought it, which was $200,000, plus the net income for the next 3 years, minus the dividends for those 3 years, which gives us an ending retained earnings in the sub for the sub of $650,000. That's what they would have on their books. So that's how we get the $650,000. And then we take the credit to investment in Danny Tech on the work papers. Entry A, we recognize unamortized portion of the fair value allocation. So the patent now, 2 years have gone by, and we're at the end of the third, but what we're going to have to do is look at what would be the patent value at the beginning of 2018, which would be $50,000 minus 2 years of $10,000 each, giving us a $30,000 balance. Goodwill would have not been adjusted except if there's impairment, and then we take that against the investment in Danny account. Entry I, we're going to remove Danny's net income recorded on the parent's books, and since we're using the equity method, it would be the $280,000 minus the $10,000 amortization, and we would take it to a credit to the investment in Danny account. entry D, we would eliminate current inter-entity dividend transfers. So we would debit investment in Dannytech and zero out the subs dividends declared. And this is for 2018. Remember that, we're in the third year. The next thing we do is book the amortization on the patent. So now we've written off 3 years on that patent. And then the last thing we would do is eliminate that intercompany transaction of $25,000 by eliminating the accounts receivable on the subs books by crediting accounts payable, and the accounts payable on the parents' books by debiting, we eliminate the accounts payable, which would be on the subs books, and eliminate the accounts receivable that would be on the parents' books. Now, what instead if the parent had been using the initial value method for the investment in sub? Well, here's the thing you have to remember is that means that the investment would still be showing a balance of $800,000. So what do we need to do? Well, we have to do what we call entry C, because the initial value method ignores 2 accrual-based adjustments. The parent has not accrued the percentage of subsidiary net income earned in the past years in excess of dividends, and the parent does not record amortization expense under the initial value method. Now, here's the thing. Remember, the adjustment has to back out the dividends because we have already recorded under the initial value method, we have recorded dividends as revenue. So we've already recorded a portion of the net income via the dividends. So entry C is added to the worksheet to convert the previously recorded balances to the equity method as of the beginning of 2018 in this example. So entry C, the increase since acquisition and subsidiaries retained earnings during past years, net income less dividends, times the percentage ownership if this is not 100% owned by the parent, and the parent's percentage of total amortized expense for these same past years. In this case, it's 100%. Entry I removes intercompany dividend income and considered dividends to the parent, so entry D is unnecessary. Now, here's what we would do, is we'd first look at how do we come up with the adjustment. So, this is what would appear on the parent's books, the $800,000. We have to adjust, needed to convert to the equity method. We would add net income minus dividends for 2016 and 2017, and then we would less amortization for 2 years. So this is what the balance should be in the equity account on January 1st, 2018 in the investment account. So the entry would be investment in Danny. We would debit the investment account by $220 and adjust the parent's retained earnings by the $220. Now, what would happen if we had been using the partial equity method? Well, we know that with partial equity method, the only thing that we're not recording is the amortization. So, if the parent uses the partial equity method to account for the subsidiary after acquisition, entry C is used to convert to the equity method. In this case, again, only the amortized expense for the prior years must be included. Under the partial equity method, the parent accrues its share of reported subsidiary income, but it does not recognize any acquisition date excess fair value amortization. So we start with the investment account original balance. We know that it would have been adjusted for net income minus dividends. So the current balance using the partial equity account in the investment account would be $1,040,000. Now what we have to do is adjust for that amortization. So the adjusted balance for the equity using the equity method should be $1,020,000. So again, what we're going to do is we're going to adjust the parent's retained earnings by $20,000 and adjust the investment in Danny account by $20,000. So we're going to reduce retained earnings for that amortization for the 2 prior years, and we're going to reduce the investment account by $20,000. That concludes the presentation on what do you do depending on the method used by the parent to keep track of the investment account on the working papers. And remember, these are working paper entries.